Hello everyone and welcome to another Elliott Wave Forecast Charts of the Day video. My name is Eric. Today is the 25th of June around 9:56 p.m. Eastern Time. And here we go. We're going to take a look today to, as we always do every day, to one instrument that we pick to provide for free the view that we provide to our members in Elliott Wave Forecast. Today's instrument is going to be the S&P 500. This is the latest chart presented to members of Elliott Wave Forecast about the S&P. The S&P 500 is in a correction as we speak. It is ended the cycle from May 14 and and the instrument most likely is still trading within the cycle from March of 2020. So then the market this week specifically, it was a little bit choppy. And the market has been a little sideways. Every rally is sore around this area, which is around the 618 retracement area, the 50.76.4 of the decline over here, but eventually is to the dot, the 618 from this area in the right Elliott Wave down, assuming that it did 5 weeks down. And it did a flat in the middle as a connector is being sold the 3144 area, which is the 618 here, and against here. Every time that we reach that area, which is a kind of a blue box in retracement over here, the index has been selling all week every time that it reached that area. There is a reason why the instrument has been selling that area, and the reason is first that we believe that the first leg here was impulsed. We believe that this decline here is in 3 weeks, and we believe that consequently with that is doing a flat in the middle. It's an ABC lower with a flat as a connector. Now the S&P right here, the highest chance within the indices is a drop to this area. Why do we base that? We base that first in this log here taking place with momentum divergency. That's usually a recipe for a flat or 5 weeks. And secondary, also we're looking at, in Elliott Wave we cover 78 instruments in the daily basis, but we always taking a look to more stocks and indices and forex pairs across the market. So technically, when we look across the market, we see instruments like ExxonMobil that is calling from, this is 6A, this is 616, is calling lower into this area. We see the whole transportation sector, Royal Caribbean, 6A, this is 616, in its more downside into the area between 42.36. We have JetBlue, also for the transportation sector, calling from 6.5, 6.16, calling lower to around 8. And we have here a American airline that also from the 5th of June related to the 16th of June, and is a little more downside. When we put any of these instruments in top of the S&P, or the S&P in top of any of these instruments, we can figure out that they are all trading the same way, right? If you look over here, we can see that American over here is trading identical, is the same as the S&P, is the same as the S&P, and we can see how they peak almost together here, and the secondary peak here also is in agreement. So if American is gonna trade here, chances are that the S&P reach the expecting area around 21, 24, or at least around 29.81 area, in which we would like to buy it. We do not recommend selling the S&P, but we see the reason why it can drop. The same way, if you take ExxonMobil and you overlay ExxonMobil with the S&P, we can see that they trade identical, and we can see how from these highs they drop together the rally, and now ideally it should drop a little bit more. If we take the S&P with Royal Caribbean, is also the same. Is the same structure. So in Elliott Wave forecast, an incomplete sequence is when an instrument makes a lead, breaks, and make the connector and break these lows. Ideally, 85% of the time, it should reach the 100% extension. Those instruments trying to make an 100% extension, eventually it will hold the S&P for rally. The reason that we don't like selling it is because the S&P can become a little sideways gear and be trapped between this high and this low before it breaks to the outside after finish this consolidation within this cycle. So eventually, guys, it's a very technical market. At least the way that we see the market, we believe that the path that the S&P is going to be hard to rally. We believe that it's going to rally eventually, but we can see to allow the S&P to reach the others to reach the string, the S&P is going to get trapped between the highs and the lows, or the S&P eventually will fall out to here or out to here, in which specifically in this area we would like to buy the index again. This is the way that in Elliott Wave forecast we do look at the market. We look at the market and we cover the 78 instrument. We look at that this. We are not unlike another services that that they label the S&P just based on the S&P. No, we look the S&P as part of the market, and consequently, when we label in the S&P, we label in the S&P together with every risk index or its instrument, stocks, and everything, because we believe in the one market concept. If you want to get explanation like this in the daily basis, join us. We offer a 14-day click here. We offer a 14-day free trial, no commitments. You can cancel. You can pick the groups that you want. It's one group per trial, and it's free for 14 days. No commitment. Join us, and you will learn how to look at the market the right way. Have a good night, everyone.